A very good morning, doctor. My name is Chong Mun Yee, Matric Number 2933497. In this video, I will be presenting my individual assignment, the determinant of credit risk for Australia and New Zealand Banking Group Limited, ANZ Bank. In this slide, I would like to discuss about the problem statement. Credit risk is one of the important risks that will be faced by each bank. If a bank unable to manage their credit risk as well, it might separate to the whole banking system that influence stability of other banks, and thus result in instability in the financial system. This study will discuss about how the factor of credit risk affect a main bank in Australia, which is Australia and New Zealand Banking Group Limited, ANZ Bank, for the period from 2019 to 2023. In this study, there are three research objectives. First, to identify the internal factors affecting the credit risk of the ANZ Bank. Second, to identify the external factors affecting the credit risk of the ANZ Bank. Third, to identify the internal and external factors affecting the credit risk of the ANZ Bank. For the research question, it also has 3 points. First, is there any relationship between the internal factors and the credit risk of the ANZ Bank? Second, is there any relationship between the external factor and the credit risk of the ANZ Bank? And last, is there any relationship between the internal and external factors and the credit risk of the ANZ Bank? Now, let us moving on to the literature review. For this part, I will mainly focus on the credit risk, loan loss provision, and yield curve. Credit risk refers to the possibility that a debtor or counterparty would default on contractually specific obligation according to the agreed upon conditions. It also known as the non-performing loans ratio. To assess credit risk for customer loans, leaders typically using 5 C's, which is credit history, capacity, capital, collateral, and conditions. Credit risk calculated by using non-performing loans divided by the total loan and times with 100. Next is the loan loss provision. Loan loss provision, LLP, refers to the profit and loss account charge set aside as a reserve of uncollected loans and loans payment. The advantage of the LLP helps financial institutions to deal with the potential loan risk well in advance, ensuring the robustness of their balance sheets. Loan loss provision ratio calculated using by the expected loss rate times outstanding loans divided by average loans outstanding then times with 100. The independent variables shown in this slide is yield curve. Yield curve is a graphic to show relationship between the charge in bond yield with maturity. Based on Adam Hayes, investors use yield curve to predict the economic situation before they are making decision for investment. There are 3 types of yield curve, which are normal, inverted, and flat. For this study, credit risk will become the dependent variables and coming with the independent internal and external variables. The other independent internal variables for this research are including return on asset, liquidity risk, loan debt to equity ratio, debt to total asset ratio, equity multiplier, risk weighted asset to total asset ratio, Tier 1 capital to total asset ratio, leverage and capital adequacy ratio. Well, for the other independent external variables, which including GDP, inflation rate, interest rate, exchange rate, research money, and market risk. Next is the methodology. The Australia and New Zealand Banking Group Limited, as known as ANZ Bank, is chosen as the research object and analysis in annual report data from 2019 to 2023. The study used multiple linear regression analysis or LS with IBM SPSS statistic version 27. Data from ANZ Bank annual reports were used to find the important variables and build credit risk models. There are three models are used in this study. The first model is the impact of internal factor on credit risk. The second model is the impact of the external factors on credit risk. Last, the third model is the impact of internal and external factor on the credit risk. Now, let us go to the finding and analysis. In this slide, I will explain about descriptive statistics. Based on the descriptive statistic table, the mean of credit risk is 0.0101 and the standard deviation value is 0.0036. Liquidity ratio have a mean of 0.3603 and standard deviation of 0.0206. The mean of ROA shows 0.057 and standard deviation is 0.0013 respectively. Next, the mean and the standard deviation of debt to equity ratio is 15.13 and 0.6136. For the debt to total asset ratio, the mean value is 0.9379 and the standard deviation is 0.0023. Leverage ratio with 0.046 mean value and 0.002 standard deviation. For the mean and standard deviation value for other internal factors, LLP is 0.0061 and 0.0012. Regulated capital is 0.0578 and 0.0026. On the other hand, loan ratio with mean value 0.6245 and standard deviation value is 0.0204. The risk weighted edge with mean value 0.4145 and standard deviation value 0.0137. Capital adequacy ratio with a mean value 0.1498 and standard deviation value 0.0075. The mean of firm size, which is 36.3 0.9659 and standard deviation is 0.7067. The last internal factor is equity multiplier, which is a 16.13 of mean and 0.6136 of standard deviation. The mean value of GDP is 2.240 with standard deviation 2.8623. For the inflation, mean is 3.5 and standard deviation is 2.494. The mean and standard deviation of yield curve is 1.974 and 1.5656. The mean value of market risk is 0.6025 with standard deviation 0.1212. Exchange rate have a 0.698 mean and 0.0327 standard deviation value. For the interest rate, mean is 1.68 with standard deviation is 1.9366. The last external factor, reserve money, have a 37.878 means and 5.0579 standard deviation. Based on the correlation tables, there are 19 independent variables that only have 9 positive correlated with credit risk, which is leverage ratio, loan loss provision, regulated capital, firm size, capital adequacy ratio, market risk, interest rate, and reserve money. While the rest independent variables such as liquidity risk, return on assets, debt to equity ratio, debt to total assets ratio, risk weighted asset, equity multiplier, GDP, inflation, yield curve, and exchange rate have negative correlated with credit risk. Based on the table, the p-value of all the independent variables is more than 0.1. This represented that all the variables are not significant to the credit risk of A and Z bank. Moving on to the ANOVA tables, as we can see, these 3 tables show that no any model that are significant to the credit risk. It is because the p-value of model 1 is 0.215, while p-value of model 2 and model 3 is 0.875 and 0.764 respectively. All are more than the significant value 0.1. For this slide, it shows that all the results of model summary. The highest adjusted R-square is model 1 with 97.10%, which have most powerful to explain the dependent variables. The model 1, out of the 12 variables, only 3 variables, which are equity multiplier, risk-weighted assets, and loan loss provision, contribute to the credit risk of A and Z bank with an adjusted R-square of 0.971. For model 2, out of the 7 variables, only 3 variables, which are reserve money, interest rate, and GDP, contribute to the credit risk with an adjusted R-square of 0.402. Well, for the model 3, included 19 internal and external independent variables, but only 3 contribute to the credit risk with adjusted R-square of 0.579. These 3 variables are reserve money, firm size, and exchange rate. Next, I will discuss about the coefficient result of these 3 models. In model 1, the equity multiplier, risk-weighted asset, and the loan loss provision with p-value 0.143, 0.13, and 0.178. In model 2, the GDP interest rate and reserve money with a p-value 0.978, 0.939, and 0.577. For the model 3, the firm size, exchange rate, and reserve money with p-value 0.638, 0.957, and 0.511. In overall, model 1, 2, and 3 shows that did not have any variables that are significant to the credit risk with a p-value of more than 0.1. Based on the study by Ropella 2007, has found similar results, prove that need to consider more variables and data. In conclusion, the current weight of these factors in the model is not enough to have a significant impact on change in the credit risk. In conclusion, by referring to the correlation table, there are 9 independent variables that have a positive relationship with A and Z bank credit risk. Based on table model summary, 3 types of models were used in this study. The regression model is internal variables, external variables, and the internal and external variables. These regression models provide the following result. The internal model have the nearest R-square value to 1, followed by the internal and external model, and then the external model at the last place. Well, table of coefficient shows that the 3 regression models still not significantly affect the credit risk individually. As the result, the independent variable in this study analyzed individually proved that dependent variable, which is credit risk, is affected by multiple factors. A single independent variable may not clearly explain its change. Data extraction may be poor due to the limitation of using only one bank as a sample, which is A and Z bank. And 5 years of A and Z bank annual reports that from 2019 until 2023 are the only source of data for doing this study. Based on the analysis, I recommend that expanding the sample size to improve the reliability of the results. Future research should include the data from multiple banks, not just only A and Z bank. This will provide a more complete view for the factors affecting credit risk in the banking sector. Extending the time frame for analysis can capture more data and better understand long-term trends and patterns. But next, improving variable selection by including more factors that might affect credit risk, such as market conditions, regulator change, and economic indicators is also important. By implementing these recommendations, future study can achieve more accurate and insightful results, leading to better management and reduction of credit risk in the banking sector. So that's all for me. Thank you.